So we are connecting. The content of this meeting is being sent to third party. Yep, we understand that. And I see a little redirecting bar. I think we're going on.
Let's see.
So hopefully we'll find out. I think we're live now. Okay, can you hear
Wow.
me? For some reason,
I can hear you perfectly.
so why am I hearing myself?
Oh, really?
Yeah, can
I
I like silence I'm sorry.
like
Oh, here. Can I hear you?
you can hear me? I can hear you?
Yeah, okay. Yeah. Okay. So now I had YouTube popped up, and so I was hearing YouTube directly and
Oh,
I was hearing you. So I silenced that. That's now gone. But I think I need to keep it open just to make sure that if anybody hops on, that we see any
any
questions or comments
comments?
that people might have. So here we are. Okay, technology. I love it until I hate it.
Hate it. Well, I am ready to talk everything. I have my
Yeah.
tea here, afternoon tea.
My two waters because I drink a lot of water. Yeah, so we're talking about investing and like I don't know about you, but I feel like it's a crazy world. And I know I have memories of saying that we live in, unpredictable times like never before. And so I know that this is a deja vu, but I feel like we are living in unpredictable times like never before. And I actually am sort of landing on maybe I had a false sense that it was predictable in the past, and it really was no more predictable than it is right now, which is not very predictable. But there's just so many different influences happening. So, what comes top of mind to you in the investment environment right now as we start 2024?
Well, it's funny because so if we back up just a couple of months, literally the war in Gaza and Israel came out. And
Yeah.
I had a client who basically was kind of had family in many of those parts of the world. And and I know she reached out to me and she's like, I am so scared. The market is plummeting. And I think people totally forgot about that. And she was
Not
very
totally
afraid.
forgotten about it, but
Kind
they're
of kept
thinking about it differently than they were
it.
before. Yeah, yeah.
Exactly. Well, and in fact, and I remember she coming to me and she was talking about how scared she was, that the market was plummeting, and long and behold, 3 months, 3, 4 months after, we have like a lot of stocks are making all-time highs, and
Mhm.
we had the infamous Santa rally, obviously, and because nobody wanted to, it's been an amazing year in 2023 that nobody wanted to sell their stocks and pay those capital gains. So I
Yeah.
think what they did instead was, January 1st, it's been a little bit rough the past couple 5 days of the year. But I think a lot of people basically what they did is just sold a lot of the stocks and trimmed, maybe not sold completely, but trimmed a lot
Right.
of these like
Yeah.
high flyers tech
Right.
because many of them had
Took some
50%.
profit. Yeah.
Exactly. And just kind of reduce the risk. So now we're really starting to see, and we started to see this last quarter, but a lot of the older economy, really boring, very unsexy
My
companies that
favorite.
I know that's your favorite, the dividend growth that we love as much, do actually really well. And if you actually take a look at what's been happening just in the last, and obviously we're not short-term traders or anything, but if you just look at the last, even not the last 5 days, but the last 1 or 2 months, a lot of the value boring companies have been doing really well and really outperforming. So I don't know. In my opinion, I don't think we're gonna see. I think if some people are saying, "Oh, is tech overdone? Is the AI craze over?" There's no way. I mean, I don't know
Yeah.
if you read
No way.
last night, Microsoft is adding an AI button to their keyboards.
Yeah.
Like these
Yeah.
are large companies are not going to decrease their spending in AI by any chance. Companies are starting to, incorporate it to really make sure that they don't have to hire as many people. So in my personal opinion, I think this is still going to be a good year, but I don't think we're going to have as many rate cuts as the Fed or as the market expects. They are expecting like 5 to 6 rate cuts. If you take a look at just like the Fed funds futures, which I think is absurd. Like, I think that's nuts. Like, there's no way. And especially if you look at payrolls today, they did really well. So I am still optimistic, but I think we're going to see returns in like the single digits. We're not going to see the 50% returns that we saw in the tech stocks like last year. We could, and I could be wrong. And, I'm not a
Yeah,
genie, but
yeah.
that's a little bit of my opinion and like kind of what's happening.
And there are just so many different factors that go into it, right? Which is what makes it so confusing, what makes me realize that maybe I was just falsely thinking that it was predictable in the past, because any number of things can make things go sideways. And the government can choose to do things, the Fed can choose to do things, people can choose to do things that are going to make a big difference. And you talk about the market, and I think it's so interesting because like it's not about the market. I mean, it is about the market, and everybody looks at the market, but really the market going up or down is a reflection of like those top 7 stocks, right? It's not truly the market going up and down. It's those 7 stocks going up and down.
There's
And how
still
are those 7 stocks
593.
going? So yeah, I mean it's really sort of interesting, and I think that a big
Right.
part of the reason why it went down is because of Apple getting hit, which if anybody follows me, they know that I feel like I was thinking it was going to go sideways for a long time. I'm amazed that it has stayed, as strong as it has, and I think that it's coming into some of the problems that they have. And I have to tell you that I was listening to a podcast, a Wall Street Journal podcast yesterday, and they were talking about um, Apple, and it was a webcast about, I mean, yeah, it was about how if you are on Apple phones and you're texting, you get blue messages, but if you have to text to a Android person, I am an Android person, you get a green message and it's a lame situation, blah, 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 blah. And I experienced this because I'm in an Android Apple family. And so like we deal with this, and we have to go over to WhatsApp to
Yeah.
do like pictures and videos and things like that. So I'm totally there. And but they were talking about one of the presentations that Cook had, where somebody in the audience said, "Hey, are you going to make it so that, I can text to Androids? Because my grandma has an Android, and right now I can't text her." And he said, "Well, your grandma should get an iPhone. Go buy your grandma an iPhone." And I was sitting there thinking, oh my God, like, I think that Apple is so elitist, and like so many people feel like they have to get it, and they go broke, they go into debt to get it. And as a financial therapist, like I have an issue with that. And now he's saying, you better have enough money, and you better have enough money to buy it for your grandma too. And I'm like, like, where has this world come to that guy in the ivory tower says that like everybody needs to get his so it's mind blowing, and I'm going to get a lot of flack probably back from this because everybody, like 80% of the US population has iPhones.
Yeah.
And they've set it up so that you can't. And the whole thing was about how this family has 25 extended family members on, and like when people get married, their spouses are on, but one spouse has an Android, and he can't join the chat.
He's
And
like an
it's just so,
outcast.
yeah, he's an outcast. And
And
for a minute, and this is the thing, for a minute, there was an app that allowed him to get in on his Android, and Apple shut them down. And they're
yeah,
trying to say that they don't, that there's no antitrust going on here. Like, I think there's a monopoly happening, and
yeah,
he better go buy himself an Apple in order to be able to talk to his family members. I mean, it's just crazy. So, and that gets back to that antitrust, which is
yeah.
very interesting right now with because we have always been an antitrust country until probably the last 40 years, and we've decided that maybe it's not a big deal. And this is how how the 7 happened, right? And so we as a culture get to decide right now, is that okay to let winner take all happen? Or are we saying that that's not the most robust that we can be, and that does not cover ourselves. And like, what happened in COVID and the supply chain breaking down, that was all just in time, super efficient stuff, but it leads to not being very robust. So, we're looking at Apple.
Yeah.
We're seeing that they're getting affected by other things outside of the United States. Actually, everything that I've just been talking about is inside the United States. Apple is getting hit because of things outside of the United States. But when will that domino fall? When will that domino that is happening in the United States, which is their number one market, how is that going to affect them, in a year, 5 years? I have no idea. I have
Yeah.
no idea. And we get to decide as a society, what do we want to, what direction do we want to take that in?
I 100% agree. I think the whole Magnificent Seven, like the only real risk that I see in them is the whole antitrust issues. That's, to me, that's the only risk. But then you realize, with the market, there's already, 493 companies out there that are, some of them are like really changing the lives. I mean, one of the great example of it would be Eli Lilly. Eli Lilly. So I was just in Spain, and Eli Lilly came out with a drug called Ozempic. Ozempic is this, for those of you who don't know, I don't know exactly how it works, but it's like I think it was started as an anti-diabetic drug for obesity. And the way it works is you get like a injection every single month. And what it does is it like stops the whole mess, like the whole like ability. You know how when you eat, sometimes you eat because you have anxiety, but not because you're actually hungry. Most people eat because of like, brain chemistry. It's not really like a gut issue. So anyway, so it works to control that. Long story short, that drug was made for people with obesity and at risk of diabetes. I go over to Spain. I'm talking to all these people, and they're all taking these drugs. And I'm like, for us, like in our portfolios, Eli Lilly is one of the biggest, is a big,
right.
It's actually it's a big, we own about 5% of it. So it's a large position. It's one of the largest positions. And at the same time, I'm looking at a lot of the times, like the reality is like when you're investing in the market, like you said, 60% of your, almost 84 or 85% of your returns have come from the Magnificent Seven. Yet there's other companies out there like Eli Lilly that are transforming the healthcare industry, reducing the cost, right? Because if you cut that back on obesity, a lot of the healthcare, and so it really interests me. And so I think that's where a lot of the opportunity for people that are not just buying the S&P 500 and leaving it alone is there. But I do agree. I think last year, obviously the S&P 500 did very well because of those 7 companies. Because Nvidia is the one powering up, right? Your Microsoft,
right.
ChatGPT, all the things. So I think it's really fascinating. But for me, what I'm more concerned about is if this keeps going on, right? Like the whole market cap weighting indexes, why don't we just buy 7 companies and leave it alone? Like, what's the point of us tracking the market? And so this kind of brings us back to, are we actually gouging like the market in the way that it should be? Just because these companies have become so large, should we have different benchmarks now? Should they be more like an equal weighted index, like the S&P 500 equal, to really gouge the market? Because at the end of the day, as financial advisors, even though we're long-term investors, the reality is that people are going to look at the S&P 500, the market weight, not the equal weight. So we are forced to kind of have a benchmark portfolio managers, and it makes everybody just have to buy the Magnificent Seven, which gives them more money to do things, and it just like becomes a spiral. So I think there's a big issue in the portfolio investing world where portfolio managers are forced to buy these companies so that they don't risk lagging the market, and they don't risk being completely different from the benchmark, especially pensions and things like that require, more closely to benchmark. So that's
that's a really great point that, it does sort of force people. It hasn't forced me, but it's forced most investors to be able to keep up with the market, which is actually like, why
Yeah.
is that the benchmark? And the fact is, yes, it's the benchmark because it's been going up for the last 20 years, but what if it goes down for the next 20 years? Like,
Yeah.
when do we decide it's not the benchmark anymore? And yes, it's sort of a self-fulfilling thing. And like those seven, magnificent seven, are they overvalued? And everybody is looking at, they're paying a price now with the expectation of a cash flow for the next, say, 10 years. But that cash flow may or may not happen. It's sort of a wish and a prayer
Yeah.
that they will grow into the valuation that you're giving them today.
Yep.
And most people don't realize that. Most people don't realize that you're paying a price today, not because of what the revenue is today, but because of the expectation going forward, which is why interest rates get involved. Because as interest rates go down, then that changes what that formula is for what is that future value of that income stream. It's different if the interest rates are low than if it's high. But the fact is, we don't even know what the income stream is going to be, right?
Exactly.
And so it's all just sort of a guess, and investors don't really want to talk about the fact that they're guessing.
Yeah.
And to a certain extent, you do need to make the decisions on the best information that you have today. Like, we can't do anything else. And so investing, I think we will all agree, investing in stock is the best long-term solution. But I will give the caveat that I say that's 10 years or more. You can invest in stocks today and have less money in that account in 10 years. If you don't put any more in. I mean, the stock market does not always go up, and people have totally forgotten that. And they think that, oh yeah, it can go down, but it'll bounce back right up. So buy the dip. No,
Yeah.
it can and has dipped for 10 years. And
Hey,
so, if you need that money tomorrow or you need it next year, like, that is not the place to put that money.
and something very important that I feel like even professionals forget about it is that you're looking at historic, right?
Yeah.
But let me
Yeah.
tell you something. The S&P 500 20 years ago looks very different
Mhm.
than the S&P 500 today, right? Today, it's
Yeah.
mostly the tech. 20, 30, 40 years
Yeah.
ago, it was much more balanced in the energy, in the industrials, in the
Yeah.
healthcare. It's a very different index. So when you're looking at history, you're looking at a very different index. And so it's like, okay, we're using all this mathematical formulas. And I know Vanguard came out with a study basically stating that if you invested for 20 years, your risk of losing money almost went down to zero, because there's never been a place that in 20 years you
Right. In
lost
20
money
years. Right.
in
Yeah.
20
Yeah.
years. And I forgot what the percentages were, but then I'm like, it's very different. The companies,
Yeah.
the companies in the 1950s were very freaking different. It was all railroads. It was energy. It was like the boring. I mean, it was like the unsexy
And
stuff that made money. No.
And in 10, 20 years from now, it's not going to be the Magnificent Seven. And
Exactly.
what cracks me up is that Microsoft was a hotshot back in like the 2000s, and then was a complete dog and nobody
Yes.
wanted to own it. And now it's back to being a hotshot. That happened. Most of the time they don't come back like that. Most
And
of them, they're
Apple
like
too.
GE, where they drop and they're gone. Yeah, Apple has gone through some, not quite as bad as Microsoft went through, but
Yeah.
yes, Apple has also gone through. And people think that it's like it was always a winner and that they always had it, and they always, no, that didn't happen. And
So
to
true.
your point, what people don't realize too is the S&P 500 index. They think that an index is some kind of magical, like, static thing. No, it's actively traded. It's just,
Yeah.
a buy and hold. It was different 10 years ago than it is today, and it's going to be different 10 years from now. It's not a static. It is people making decisions about what should stay and what should come out and how it should be balanced. And actually, who was it? The NASDAQ that was just not NASDAQ, sorry. The Russell 1000 that was
2000.
rebalanced,
Oh, I
and
don't
they
know,
made
but
it equally weighted.
Tesla wasn't part of the S&P 500 2 years ago.
Yeah,
Uber wasn't part of the S&P 500 like 2 years ago, right? Or a year ago. So it's like,
yeah,
it's at the end of the day, it's human beings. It's a couple human beings making the decision for the entire planet. Because at
right.
the end of the day, the United States everybody follows the United States. Even if you're in South America, if you're in
Yeah.
Asia, if you're in Europe, the United States is what people look at when it comes to a benchmark. And that's the reality. When you live in the United States, you don't realize that, but when you lived abroad, you realize how important that is. And that's why these people, it's like, does Tesla really deserve to be part of the index? Right? Do they really deserve? I mean, maybe you could argue. Does Uber really deserve that? They've lost billions of dollars. Like, and
Yeah.
and a lot of these people, all the other these companies are becoming part of the index simply because of cooking the books, right? They're
Yeah.
making it look like they're making profitable. Because, right, so for those of you that don't know, that are watching this, the S&P 500, there are it's a rules based index, so you have to have consecutive quarters of positive growth. But a lot of the times, right, Tesla, the way they would kind of get around that was to sell credits to China, and then they're able to be profitable. But at the end of the day, Tesla is a car company, like, and so you have to, there's, at the end of the day, it's investor CEOs and management team, they're cooking the books to make it, because once they're part of the index, then so many, maybe you don't, but like most portfolio managers have to buy it to kind of keep up. And then it's like the index is the self-fulfilling prophecy. So I think it's really important that we really think about, is the S&P 500 the best way to gauge basically the US economy, when the reality is that 40 to 60% of the revenues in the S&P 500 are outside the United States. So why isn't Europe why don't they use the S&P 500 to gauge Europe? Or why don't they use, you know what I mean? Because these companies are so international, so global.
Oh, yeah. Yeah. Right. 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 Right.
So
Yeah.
so and so we automatically just, buy and hold, just buy the S&P 500, don't think about it, just buy it. But it's like, are you really buying the best thing for the world, for you?
Yeah. Right. Yeah. And what's going to happen? And it is stacked to their advantage, and will it continue to be? And that's an interesting question. And maybe the answer is yes. Maybe, maybe the big money is going to have all the power and is going to be able to manipulate the system so that, the Magnificent Seven will stay the magnificent, or maybe we'll start to realize that that isn't in our best interest to allow Apple to gobble up, whatever is going to be their competition, or Google, or Facebook. And we're just going to have to see. And I mean, I am a capitalist, but I feel like we don't have a fair playing ground, and that there are advantages to certain people to
And I have
make
to
it
say,
big.
like, people would argue, oh, in the United States, there's no corruption. Oh, that's only in, like, Latin America and Africa. Like, you know what I mean? There's
Yeah.
the corruption. I see it right in my hometown, like right in Boston. There's corruption everywhere. Like, the people with the money, they're gonna pay people off, and they're gonna keep the power. And that's the reality, is that's gonna be what that's the reality. So I think they're gonna keep their power. I see it very rarely. There's always like one or two people that stand up, and maybe when enough human beings kind of corrupt or go against the government. But as long as we have politicians making decisions, I think it's going to be hard to have these companies step down. And the reality is, like, Nvidia is a great company, Microsoft's outstanding company. Like, I don't think they
Yeah.
deserve to step down. Apple, I would agree with you. I think after Steve Jobs, Apple hasn't been the same, but people still love it on Wall
Well,
Street.
but it really gets back to that power thing. Like, does Microsoft have everybody's best interest at heart? Do they even know everybody? No, of course not, And so what is in their best interest, and which is probably in my best interest also, is not necessarily in everybody's best interest. And so that's where it gets, we tell ourselves stories about the way it should be, and should it be that way, or is there another way that it can actually be? And I think as long as we're using dollar signs to keep score of how worthy we are, which is to me a little bit ridiculous, but whatever, then that's going to continue to happen, and it's unfortunate. And but getting back to investing, is it going to
Yep.
impact investing? I mean, I think that's really the answer. And like, is antitrust going to come in are the healthcare, well, actually the healthcare is already, prices are coming down. I think we might have talked about that before,
Yeah.
that the new research says that we're actually back to like 2019 prices in healthcare. So not only has it not gone, it hasn't gone up. It's been staying pretty level. Not to say some things haven't been going up, but that overall, because of Obamacare, because of things going to generic, and so drugs that are hugely expensive, like the drug that you were just mentioning.
Ozempic. Yeah.
Yeah, the Ozempic, and I think there's
This is
another
not
one
an
too that.
advertisement for Ozempic, by the way. Please speak with your healthcare professional. We are not doctors.
Yeah,
I feel like we
and
needed to say that just in case.
right. And I think that a lot of people are using it incorrectly, but that's a whole nother issue. Um, yeah, but there's some shifting happening. And so what's going to cause things to go sideways or go down? And it's hard to say. And so, we started with the interest rates. Our interest rate's going to go down, and I agree with you. I don't think that they're going to go down as much as people say. And really, there would be no reason to do a drastic cut in interest rates unless we have a recession. And that's what sort of blows my mind, is that the stock market is telling us no recession, things are great. And the
Yeah.
bond market is saying there's a recession coming and we need to cut rates. And that doesn't make any sense.
Well, the bond guys, number one, I think the bond guys are the smart guys. Usually people that trade
Yeah, it's
fixed
smarter
income, right? That's
than
the saying.
yeah,
And number
yeah.
two, I was actually listening to one of the guys at JP Morgan who was actually stating that the leading the coincidental indicators say we're fine. Leading indicators, it does say that we are going to have a recession, or maybe we're having the stock
One right
market
now.
recession right now, right? And especially the way the stock market's acting with like things opening up really well in the morning and things closing down in the red, that tends to be a sign for for a bear market. And if you look at a lot
Right,
of the technical indicators, usually
right.
when you're in a bull market, stocks will open down and then they will close up. When you
Hmm.
are in a bear market or a down market, a lot of times
Right,
stocks will
right.
open up very strong and close down. So
Yeah.
that's what we've been seeing. So and if you look at a lot of the indicators, it's extremely greedy. A lot of we're in a, like, the whole last year we did really well. We're at extreme greed. So I'm personally not investing everything. I'm kind of putting stuff in treasuries, at in short-term treasuries, buying some value things that were unloved last year, and keeping extra cash because I think we're gonna have a dip. And I think we're gonna
Yeah,
be able to buy stocks cheaper. Um,
yeah. But I do think that it's going to be like a pick and choose thing too.
yeah,
Back to your comment before, is that I am buying some stocks that I feel are selling at great values because they're being overlooked and they have great dividends and they're strong cash flow, and they should be able to survive a recession a lot better than other things. And I'm taking profits off the things that are really high. It seems to be overvalued to me, at risk of pulling back. So, and that gets back to diversification. And they say
and balance.
that, yeah, and diversification both between stocks and bonds and also within stocks and bonds. And I have been, and less so now, but the last 6 months, I've been actually building out my bond ladder. I usually like to have a 10-year bond ladder where I have bonds maturing every 10 years. And when they dip down below 3.5 a while back, I stopped doing that and I went short term like you
Yeah,
did. But then as it went up to, 4.5 to 5.5%, I
5.
started building that back out, because if interest rates go down, I want to have that locked in.
Yeah,
Those short terms are going to go down fast, and I want to have some that go out 5, 10 years at that higher rate. And so I was able to lock in a bunch at the 4.5 to 5%. But now it's like it's back to, I can't go out 7 years and
yeah.
get 4%. And I've always said that bond rates are historically between 3.5 and 4.5%. Not that you should predict the future based on the past, but I feel like if you can get between 3.5 and 4.5, you're doing good. And what's really interesting is that as it came down below 4.5, I was like, well, if I can't get 5, I don't want to invest. And I had
Yeah,
to like
I
kick
was the
myself and
same.
say, don't get greedy, Tara. 4.5 is fantastic. You buy that bond. So as long as I could get in that like 4.2 and up, I was buying it. But now you can't. You can,
The
as
10
soon as you
year.
hit 4 or 5 years, it's down below 4%. And the 10 years, yeah, like at 3.2 or something like that. So I'm really glad that I locked some of those in.
If I
But
I can tell you right now what it is, because I'm always looking at the I'm using my new screen. Okay, maybe not. I thought I had it, but no.
yeah.
but
So anyway, so that's the thing
it's true.
about the
You
short
can't
term
get.
and the
It's like 3.8.
yeah. But the when they went high, and if they go high again, which I don't think they will be going higher, because I think that we are heading for at least a softer recession. And I think, because, and the thing is, the only reason why they would bring the interest rates down is if the economy were softening. Interest rates is one thing, but there's a whole bunch of other things that they're looking at too. Not interest rates, inflation.
Inflation.
Inflation is one thing that they're looking at, but there's a whole lot of other things that they're looking at too. And so I don't think that they're going to reduce interest rates until inflation gets down. And the reason why they said that they would be able to lower it is because they feel that inflation is on a trajectory that it should get below whatever. But the fact is, if the economy stays strong, the inflation will not come down. It will stay above 2. And if it's a strong economy and it's staying above 2, they're not going to reduce it. They're just
Yeah.
not. And if it does start to weaken and the inflation comes down, or if it stays strong and the inflation comes down, they're still going to have a hard time in reducing interest rates very much if they have a strong economy, because as soon as they start making money, loosen up money, monetary policy, then it makes people spend more. I mean, that
Yeah.
is the natural reaction, is that you're going to invest more. Now that it costs less to borrow, I'm going to spend more. And if you already have a strong economy and you're spending more, inflation is going to go up. So they have this balancing act that they need to do. And really, the economy has to weaken before
Yep.
they can do much of interest coming down. They just
And it's
aren't going to
not.
do it
And it's
while it's
not
strong.
weakening. Look at
And it's
how strong
not.
the payrolls were. Like everything is looking really good.
Yeah.
Like
Yeah.
you know.
And if
Um.
jobs are good, then if inflation comes down and jobs are good, there's no reason to reduce the interest rates. There's just a whole lot of reasons not to reduce inflation rates. And really what I think the Fed has been telling us is that there's a trajectory that's happening that if it continues, we will be able to reduce interest rates. But the fact is, if the economy stays strong or gets stronger, which is what the stock market is saying is going to happen, if that's
Yeah.
true, if that happens, interest rates aren't going to come down. And if they don't come down, then there's going to be this backlash of people who are buying the market because interest rates are coming down and finding out, oh, they're not coming down.
Yeah.
Oh, okay, we need to get out of there.
Yep.
And
That's
then
why I
that's
think
going to
the
be,
market is wrong. Like if you look, I always look at the Fed funds futures just to gauge what the market's saying. They're expecting rate cut in March, a rate cut in June, rate cut in like literally 5 rate cuts. I'm like,
yeah,
huh? I'm like,
yeah, yeah.
I'm like, I don't know. I don't think so. Like,
Yeah, I don't see
I
that
would
coming.
love it. I
So
would love that because I love borrowing and investing, but
I love
no.
getting bonds at high interest rates and getting
That's
income.
true.
So
I know.
I love the high interest rates.
I
And I think
know.
it causes a safe and sane environment. I think that, that easy money for so long is part of how that was one of the pieces of how we really, I feel like we're broken and we need to fix it. But the thing is, nobody wants to do it on their watch. Right? Nobody wants to fix it and have things go south on our watch. And the other weird thing
That's true. I
that
do. I have a
comes
love
into
hate.
this, yeah, and we all do. Because the other part of that is the reason why we do so well is because we rig the system to encourage spending, to encourage borrowing, to encourage growth. And so, the government will pour money in, they'll make the interest rates low, they'll do all they can do to help people spend more money, to help the economy grow. But is constant growth really the healthiest thing for us? And this gets back to, like, I remember when Obama was in office, and we had just this like steady chug up, and people were like, oh, this can't last forever. And I'm like, well, hell yes, it can, because it wasn't hot. It was just steady. It wasn't anything extraordinary. It was boring old, just steady as you go. And I'm like, we could do this forever, and I would love that. But then, no, we don't love that. We like to have a little excitement. So we poured some gasoline on the gas, and everything went great, and the growth was great, and the stock market went flying. But then we're overheated, we're overvalued, we're over everything. And so the only way to make that sustainable is to let immigrants in so that we have more people spending,
Yeah.
or pouring more money in from the federal government, or people going into more debt so that they can spend more. I mean, there's not a whole lot of levers we have here. So
Yeah.
how are you going to do that? And the people who don't like the debt, well, if you stop having a debt, and actually you can look historically, I think it was Clinton had zero debt. He balanced the budget, and we went into recession.
Oh,
We depend on that debt spending to make the growth that's happening. And you can't want zero debt and growth. Like, it doesn't compute. It doesn't go
yeah.
together. The growth comes because of the debt. So, like, pick your battles. What do you want? Do you want growth, or do you want debt? And I say, actually, a little bit of both would be
Yeah.
just fine.
Yeah.
Not too much of either is just fine with me. But it's when you get into those extremes that you have problems.
I agree. Well, balance is the spice of life.
People hate balance. Oh my gosh. And I don't understand why. And if you think about it, balance is like so hard, right? I think about
I'm
like
not balanced.
losing weight is easy, keeping weight off is hard, right?
Yeah.
Because like that changes in the reward, and then all of that, like that's easy. But when you get to where you want to be and you're trying to eat just enough to stay where you are, 100% hard. It's really
So
hard.
true. Yeah, that's where I am. I'm like, oh, I love what I look like, but then I'm like, oh shoot, I'm gonna be eating a lot. Then I go to Spain, I lose weight, then I gain, then I lose.
And why is that? Because you're exercising more, or the food isn't as good?
The food is actually so good. Like I can't even tell you, like everything tastes good. Like chicken just tastes good. The milk is
Yeah,
amazing. And it's just
yeah.
so much, I feel like it's more satiating. Where like I will
Right.
eat and I'm satisfied and I don't have this constant like craving. Whereas a lot of
Yeah.
times this is like obviously, but and I like good food, but like sometimes I'll still have like a craving. I'm like, I need chocolate. I need this and this. And there, I just feel like I can eat and I'm satiated. I don't know what the heck they put in all our food here, but
Yeah. And it makes it so that you have to get Ozempic, right? So they make
exactly.
the food, make it so that you want to eat it and buy it and gorge, and then you gain weight, and then you have to buy that high drug in order to take it off, and that's how they win.
Exactly. But it's so funny in Spain. So literally everybody I was talking to was like, "Oh yeah, I take Ozempic. I take
Yeah.
it. I took it. It was great." Like I had a client, yeah. One of my clients took it, but she had like almost diabetic, and she said it was amazing. She said she's gonna have to take it for the rest of her life. But yeah, people I'm like, I gotta look into this. Not healthcare advice.
Yeah, no, no. And I think exercise, meditation, eating good whole foods without preservatives, yeah,
But
that's a
most
good way
people are too
also.
lazy.
Yeah, yeah, they want the pill, right?
They want the quick fix,
Yeah,
just like they want a quick money, they want the quick buck, the
yeah,
quick fix. So
yeah. Yeah, we all need to calm down just a little bit, eh?
true.
But that's not the American way, so, whatever.
I know. That's how America gets. So I think being obsessive can sometimes make you very successful. And I think that's
Yeah,
how a lot of these companies, right, from obsessive
yeah,
CEOs that just
yeah.
wanted to win. So it's yeah. it maybe.
Yeah, but in to that point, yeah, win in one area, but potentially lose
Lose.
in other areas. So like pick your battles there too, right? Like is money the end all be all, or is having a happy marriage, having, a healthy life and getting outdoors, like what, and to be honest, like it's your choice, right?
Yeah.
I'm not here to say what people should do. It's like what
Yeah.
what works for you and what makes you happiest and most fulfilled. But sometimes people think that something is going to make them fulfilled, and they work and they work and they're just a rat on the wheel, right? On the
Yep.
treadmill and not getting anywhere. So
I
like
kind of I want to finish up
understand.
with something that my economy professor said to us when I was 18, first day of econ 101 freshman year. And he said, it was a Guatemalan person, but this really stuck with me. It was a Guatemalan person and an American. The American was 65 years old, had just retired, and went to Guatemala and was on looking at the beach. And all of a sudden, he sees all these young people on the beach just laying back. And the American goes, "Why are you on the beach? You should be working hard so that when you're my age, you can go to the beach." And they're like, "Why should I do that? I'm already on the beach." Like,
Yeah. Why should I wait
and that
till then?
right, exactly. And
Yeah.
I think that
Yeah.
it really struck with me because
Yeah.
I think that's the reality is that yeah, and we see that with millennials now where they want to live their best
Yeah.
life and have
Yeah.
balance and really work but also enjoy life a little bit.
Right. And does it require $20 million to have your best life? Do
Yeah.
you need to have, that magazine lifestyle, or is a more modest? What also strikes me is that I've talked to a lot of people who grew up poor and are not now. And
Yeah.
I asked them about, their growing up, and they're like, I didn't know we didn't have everything. I felt like we had everything. It was rich and we had family and we had, stuff. And yeah, I guess it was hand-me-down clothes. I didn't know that back then.
Yeah.
Like I had to learn that I was
Yeah.
not living the right lifestyle. And it's like,
Exactly.
why are we teaching ourselves this? Like, if you can be satisfied with that, why are we saying that that's bad? Why don't we embrace that? Why do we put ourselves in this thing where now we have all of this nice stuff and we have fancy clothes and stuff, but we're miserable and unconnected and have no friends? Like what makes that?
Exactly.
Not to say that all rich people don't have friends. That's 100%
Yeah.
not true. There's definitely a balance in that. But
But
I think
it's
that a lot of people think that they need that in order to, live the best life. And it's like, no, you can live your best life at any income level. It's really
yeah.
your mindset that
But
makes it.
it for me it was a lot of the times, yeah, growing up my mom would always tell us like no to everything. I'm like, "Mom, can I have a
Yeah.
Tamagotchi?" I remember those
Yeah.
things. My mom would,
Yep. I
"No."
took care
Can
of
I have
four.
yeah, I'm like, "Can I have a teddy bear?" "No." And my mom would always say, "We're poor, we're poor." Like it was always like the way she rose that. And I'm like, she
Oh.
would always, and then they when we would fly, my sisters, we would fly in like the back of a plane in economy class, and they would go in first class. And I was like, "Mom, why can't we go in first class?" She goes, "No, no, we're poor." And then like remember my mom like having like a lobster roll and a pina colada. I was like, "Mom, can I have the lobster and the pina colada?" She goes, "No, no, no, that's too expensive." So growing up, I just grew up like we were like so poor. Even looking back on it, we had like the best life. Like we played golf, tennis, went to amazing schools. Like so, I'm like,
Yeah.
"Mom, don't tell your children that," because I feel like now I'd like, yeah. So
Are
like
you
growing up.
poor, Sylvia? Are you poor?
But like, yeah, we had a minivan. I was like, "Mom, can we have a convertible?" "No, no, we're poor." Like, but it was, I think it was
The
good because it
stories
made,
we tell ourselves.
yeah.
Yeah, and it helped you have a balance, right? That
Yeah.
you appreciate first class. You appreciate all those things that
I
you
don't
can
fly
have.
first class. I go in economy, but
Yeah,
yeah, because I
me
guess
too.
that's why now, yeah, because I'm like, oh no, I'm not gonna pay that.
Yeah, it was funny. We just went to, I took my daughter and some people to a play, The Grinch, at the Pantages in LA. Fabulous play. It was really great, but it was like $250 a ticket. And
Oh
we
my.
were all like, wow, that's like a lot of money. And one of my daughters didn't want to go because she's like, that's too much. Like, I don't enjoy that experience enough for you to spend $250 on me. I'm not going. I'm like, okay, fine. But like the rest of us, we were there. And then we were also talking about we're going to South Africa soon. And we were thinking about going first class. We don't go first class either. And
Yeah.
and I was like, well, wait a minute. I just spent $1,000 on play tickets, and it's going to be a heck of a lot more than $1,000 to get first class to go to go to South Africa. I said, I would
8,000.
much. I
I
know.
looked
Well,
it
I
up.
found out later. It's like, and I was like, I'd rather spend that $1,000 on play tickets. Like I'd get way more enjoyment than in that
Yeah.
first class. And then I found out, yeah, no, it's like $8,000. I'm like,
Yeah.
all the play tickets I could get for that? Are you kidding? No way. I'm going to the play. You guys can do whatever you want. I'm going to plays.
If you do business class or first class, it has to be with points. It just does not make any sense to pay eight to Qatar Q suites to Tanzania. I looked it up, $15,000. But if you do it with points, it becomes like super good value.
So I'm going to tell you that for Elon Musk, he can afford to pay for a first class. So, that's where it gets back to like, for some people, yeah. I mean, if you, and it gets back to what I was just talking about, values. If that is the most important thing to you, like, figure it out, cut back on some other things. But there are going to be some people who do have enough net worth that, yeah, go ahead and do that. Like you can do that and it doesn't affect the rest of your life at all. Cool, go do
Yeah.
that. So, we try to make rules to fit everybody. And it's like, no, no,
Yeah.
like where are you at? And what are the rules that make sense for you at this point in your life and will make you the most happy? And trying to be, the $100 million heir and thinking that you have failed if you're not there or you're not on track to being there. You are not living your best life. If that's in your head, you are not living your best life.
Yeah.
Living your best life is about appreciating what you have, the path that you're on. Yes, you can strive for more, but to think that you are somehow substandard, sub whatever, because you're not there, like that's just nonsense in my book.
100%. I love it. Like,
So enjoy your life, enjoy your money, and don't get stuck in the what ifs. That's not a good
exactly.
way to live.
Learn from the
Not a good way to live.
Guatemalan.
Yes, right. Enjoy the beach today. Well, and I guess that gets back to also, I always talk about like live your best life now and in the future. So like don't live a higher lifestyle now so that you living terribly later, but also don't not go to the beach now so that you can go
Yep.
to the beach at 65. Like that doesn't make any sense either. Like getting that back to balance. Are we
Yes.
back to balance? Oh my
Yes.
God. Like is the answer to everything? Balance.
8100
Find
is.
that flow, that zen, place in the middle. Yeah. Okay.
Oh,
Well,
well,
we went
Tara,
way over time.
over.
It
I
was
know.
fun, as always.
I know. Well, enjoy Chicago, and
Thank you.
I will speak to you soon. We should do
Yeah,
another
and
one.
enjoy Boston. I hear that you're freezing.
It is. I'm in New Hampshire right now. I have a crackling fire here. That's what makes me happy.
Oh,
There is
yeah.
nothing better than having a crackling fire. Like,
Yeah.
you cannot, like a crackling fire with a cold winter day, a good, and I just love, it's like the best. It's the best. It's the
Yeah.
best.
Don't go to
If you don't,
California. You can't have a crackling fire in California.
you
Sorry.
can do it on YouTube. You can find
Yeah.
on YouTube. There's like if you just put crackling fire, like
And you can get those gas, like
yeah,
wall hanging things. That's allowed.
I know. Oh my God. Well,
Okay.
happy
Well,
weekend.
fun. Yes, you too. And we'll have to do this again. And well, when something big happens, like the recession is noted or the interest rates go down or up or whatever, we'll meet again.
Absolutely. All
Okay. Talk to
right.
you soon. Bye-bye.
Bye.